I want to talk about the interest rate hikes that we've seen around the world. The Bank of England raised rates this morning by 0.25%, which is not as extreme as what the United States Federal Reserve did yesterday, where they raised rates by 0.75%. I'll talk quickly about the mechanics as to why they're doing this and what this means for your investments and what stocks to potentially buy right now, as well as how to make money from stocks going down. That's right. All right, so I'll kick it off with what's happening around the world. So as we know, inflation is a material issue. And the issue is because of Russia, almost entirely now because of Russia, because oil prices are much higher and the poor people in Ukraine can't work on their farms. And the bulk of exports to North Africa and many countries when it comes to wheat comes directly from Ukraine, where their GDP is down 50% year over year. So what's happening is prices have risen all over the world. And what governments have to do is they have to raise interest rates in order to cool off demand. If they raise interest rates, it stops us from spending money. And I know it sounds harsh, but they have to do it. Because what happens is if they don't control inflation rates, then we don't have an economy. And it's gotten really bad in some countries over the past couple decades. For example, the daily inflation rate in Zimbabwe during September of 2008 was 98%. And a couple years ago, the daily inflation rate in Venezuela was over 1,000,000%. And so in Venezuela, they had to cancel their currency called the fuerte, ironically, which means strong in Spanish. And so what governments do is they raise rates to cool down the economy. And it's a smart thing to do in the long run, although it's painful now, I know. It's a smart thing to do in the long run. Because when the economy is not doing well, the best way to jumpstart the economy is to actually cut rates, okay? And when governments cut rates, what they're doing is they're flooding the market with more currency. And we know that when supply of anything increases, then the value goes down, meaning interest rates go down. So how can you profit from this? Well, I mentioned a couple of weeks ago to buy government bonds if the rate is, or if the rating is attractive enough in your country. Now, if you're in the United States, you can go to treasurydirect.gov and buy bonds that are risk-free. That's right, risk-free. That will earn you 9.62% per year. And so what people are doing now, because rates are getting higher and the yields on safer government bonds are getting higher as well, what people are doing is they're not investing in stocks or any risky asset class. Now, my students ask me a lot about comparing and contrasting the current inflation rate environment to the early 1980s. Well, things aren't as bad today at all compared to the early 80s. Now, in the early 1980s, you had inflation and interest rates close to 20%. It was awful. But back then, you also had unemployment that was 10%. You know, today inflation is less than 10% and unemployment here in the United States is less than 4%. So things are not as bad today as they were back then. Now, the ways to think about making money in an environment like this, and we're officially in a bear market, and a bear market is defined as the market pulling back more than 20% from the peak. And so between January 3rd and today, the market is down just over 20%. That means we're in a bear market. And so what people are doing is they're buying higher dividend yielding stocks. And one of my great students in my MBA program named Adiposi explained what he's doing, which is smart. He's using what's called the dogs of the Dow theory to invest. And what that means is this. Now, the 30 safest stocks in the United States are part of the Dow Jones Industrial Index. There's 30 of them. And what he's doing is he's taking the 10 stocks that are part of the Dow 30 that have the highest dividend yields, because those won't go down as much because you have a dividend as a safety net. That's one way to do it. Another way to look to invest is to actually do a lot of fundamental research, okay, and valuation-based research as well on your favorite companies, and I'll show you how in a second. And then what you do is you look at technical analysis. Now, I always mention to look at fundamentals and valuation first and technicals a distant third. But if you look at technical analysis and you see a stock that has an RSI, meaning a relative strength index of 20, it means it's oversold. and it's a good time to start nibbling if you like the long-term prospects of that company. Now, let me show you a couple templates that I provide my students in my MBA degree program. So in my MBA degree program, there's 4 semesters, okay? And I'm going to go to EMS, that's Economics Management and Strategy, semester 4, class number 2. And I'm going to show you a download here that I provide my students with. And this download will help you understand, and you have to click it here and then download. And I talk about this in much more detail in my MBA program. But this download here will help you analyze stocks like professional investors do. And I humbly believe there's nothing like this on the market right now. It's based on all of my work experience working in venture capital, working at Goldman Sachs, working in the hedge fund industry at Citadel, and starting my own hedge fund as well. That's me buying time while this opens up here. Okay, it's 30 megs. So the way this works is, and I apologize for the size here, it might be a little bit difficult for people to read, but there's 100 steps to analyzing a company. And I ask you 800 or 900 questions in this, and based on all of your answers, I help you create a target price and a research report. So up here at the top, and again, this is part of my MBA degree program, which you can sign up for today and start today at harounmba.com. There's 3 parts to this. There's qualitative investment research up here, okay? Meaning, what are the catalyst drivers? Is this a secular growth company or a cyclical growth company, target markets, etc.? Then here we have the second category, which is quantitative research. And on each of these tabs, you can click here to watch a video that will tell you much more about how to actually populate that tab and what all that stuff means. And then down here we have financial research, everything you need to know in terms of modeling and coming up with a target price on a company. Now, as you step through this, what happens is the data populates directly into a bunch of charts here. Okay, I like to visualize everything, and it's a fun way to invest as well. Also, an executive summary is created for you. Now, earlier today at the start of this call, I talked about investing based on fundamentals first, valuation second, and a distant third, technical analysis. And so everything you enter into this spreadsheet gets fed directly into this. And what you can do is, and I love creating 1-page snapshots of my investment theses, etc. And they love this in business as well because less is more. And so what comes out of this, and this is just dummy data, is a 1-pager with fundamentals, valuation, and technicals. And you can put your name at the bottom as well if you're applying to work for an investment job, or even put this on the back of your resume, and it'll help you out tremendously. What also comes out of this here is a detailed report, okay? A 150-page detailed report. And I promise you, if you do a ton of research on stocks, you can outperform the markets and other big hedge funds and mutual funds as well. Again, this is based on my experience working in the industry. Last thing I want to talk about is how to make money when stocks go down. Well, I have a course called the Complete Options course. And if you go to learn.harounventures.com, you can purchase this, okay? And there's a 100% 30-day money-back guarantee on everything. And a more in-depth version of this is in my MBA program. But I teach you from scratch on how to make money when stocks don't move, that's right. And also how to make money when stocks go down a lot. It's through what's called buying puts. And I have 30 different option strategies in here as well. Now, as part of that course, and as I mentioned, there's a more in-depth version available in my MBA program. You also get a ton of option spreadsheets that will help you value options. And I teach you how to value options, meaning making money based on volatility or lack thereof, or when a stock goes down and even up. I teach you how to value options based on 3 different methodologies, okay? Number 1 is what's called the binomial pricing theorem. Number 2 is Monte Carlo, and number 3 is something called Black-Scholes, which was created in part by Myron Scholes, who's a professor here at Stanford. I exchanged emails with him not too long ago. He got a Nobel Prize for it as well. And so I teach you all of these strategies on how to make money when stocks go down, or how to make a ton of money by investing a small amount and stocks go up. You can easily make 10 or 15 times your money. And the most you can lose if you buy puts or calls is a small amount you bought or you purchase as part of the put, as part of the call. I recommend practicing for at least 6 months with this though, first please, before creating your first options trade.